Coming up on Energy TV, it's a special half-hour panel discussion with legends and strategic thinkers in the oil and gas industry.
My thoughts are basically that this is one of the toughest environments I've ever seen, and I believe our basin is all about cost of capital.
Cost cutting in these times is paramount.
We explore the price of oil.
I think the strength will return, but it is so highly dependent upon the economic situation. I don't honestly see the prices breaking out of the 30 to 50 range.
Whether this bust is different from others.
You've got a penalty for illiquidity. You've got risk premiums on access to capital, both debt and equity, and that's different. And so in an environment where over the last decades we've had shrinking discount rates, and we've got an environment where we're unknown how large discount rates are today for evaluation of oil and gas reserves.
And we highlight the opportunities in these challenging times.
I, as an individual investor, have invested mostly in people over time. And people are coming free, if you will, as downturn. They're just popping loose in all sorts of interesting places. So if you can finance a team and give them adequate cash to get them through the next 12 to 24 months, I think you've got an opportunity that could be pretty interesting.
The following is brought to you by Halliburton. Halliburton, from Canada, for Canada.
So welcome to Energy TV. I'm Helena DeVries. This is a special edition of Energy TV where we've assembled a group of strategic thinkers in the oil and gas industry to offer some guidance and insight in terms of what's happening overall in the economy as well as in the oil and gas sector. Of course, it's no surprise we're in the midst of a serious recession and the oil and gas industry is reeling. So our distinguished panel in alphabetical order, we have Paul Colborne, a serially successful entrepreneur. Thanks for being with us. Thomas McInnes, one of the original founders of Tristone Capital and Managing Director of Investment Banking. Thank you. James Pasieka, partner with national law firm Heenan Blakey, businessman as well as M&A specialist. Thanks for being here. Peter Tertsakian, of course, chief economist with ARC Financial, best-selling author. Thank you. And Brett Wilson, oil and gas industry legend, co-founder of First Energy Capital and notable philanthropist. So about 8 months ago, we would have been having a very different conversation. July 11th, oil hit 147 US a barrel. It's come off about $100, give or take, from that level. Peter, what are the fundamentals telling us, and where does the price go from here?
Well, it's no surprise that the fundamentals are weak. Demand is off because of the severe recession that the world is in. The supply side is hanging in there at the moment. There's a lot of extra inventories. There's a lot of spare capacity in the system. So where we're going is probably more of the same, a very choppy sideways, trading prices $30 to $45 for most of the year. There isn't a lot of clarity in terms of the economy, but at this point I think it's prudent to say that things aren't going to get better until 2010. And until then you're going to see prices going, say, sideways with, little breaths of hope, but then probably disappointments.
There seems to be a fair consensus that the price is going to see some upward movement. Are you speculating in terms of price, $50, $60 oil for the rest of this year, 80 possible? What are your thoughts?
No, I think those numbers are too high for this year. I mean, I think the strength will return, but it is so highly dependent upon the economic situation that I don't honestly see the prices breaking out of the 30 to 50 range, notwithstanding some sort of positive news on the economic front or possibly some geopolitical issues in the Middle East or other parts of the world, which is not really a desirable way to see the prices go up.
So certainly a lot of volatility. We go from 147 to 40-ish, give or take here or there. So Tom and Jim, can you speak to M&A activity, what we've seen in the past several months, which is pretty well non-existent, and what happens from here?
Well, even if you go back to the 147 scenario on oil, one of the things we pay attention to from an M&A perspective is the bid-ask spread. And when you look at a lot of liquidity and transactional activity, what you're finding is a shrinking of the bid-ask spread between buyers and sellers. And the key issue we're finding today, not just between shareholders wanting to buy or sell equity, is you're seeing buyers and sellers of companies and assets very far apart from what it takes to own an asset. And part of that, yes, is commodity driven, but I would make a major argument and say a big part of that is discount rate driven.
Yeah, I think that's right. And I do though, see in second quarter of 2009, third quarter of 2009, some change to the doldrums in M&A activity. We've got updated reserve reports coming in for year-end, and there's beginning to be new transaction metrics established in today's changed world. And I see a number of drivers to enhanced M&A activity for Q2, Q3, 09. In particular, companies need and want to grow to have a bigger and better cash flow base to access their resource projects. Importantly also, companies want to earn a higher or better trading multiple so as to have a better cost of capital when capital does return to the sector. As well, shareholders are asking, demanding for liquidity. And I think a fourth reason that comes to mind is reduced G&A, because cost cutting in these times is paramount, and that's the only element you can control in your business.
Yeah. So a lot of that is repositioning shareholders so they can be better positioned to get access to a better market if and when it recovers, right? But in the short term, my view is you've got to prepare yourself to downside risk protect against some of the things you brought up, right? And so if leverage is a concern, if gas price is a concern, and we talked about oil, but a large percentage of the companies in town here in Calgary and the Canadian energy market, they're gas weighted. And so we have a similar downturn in gas prices. Well, a lot of people are looking at leverage positions and say, look, I want to continue to offer shareholders exposure to upside potential in this market, but I've got to downside risk protect myself, and that's a key issue.
Well, thank you so much, Tom. And certainly, when we come back from the break, because we're out of time for this segment, I want to chat with Paul and Brett about your thoughts, and particularly, Paul, you've started a number of companies. Would you start a company in this environment? How would you do so? And Brett, of course, you've always been an early-stage investor.
Again, there's great people in the market. There is some interesting opportunities. I think Paul's absolutely right. The cost of capital is a core issue right now. So most people will tend to underfinance, just adequately finance, if you will, their businesses, and anticipate that when Peter's right and the market comes back, and I really do believe, I'm more of an optimist than Peter in terms of where oil prices will go, and maybe I'm just an optimist in how quickly they'll rebound, but it might take 12 to 24 months to happen.
Stay with us. We're back in just a moment.